Every election cycle, the same promise gets made. We are going to tax the rich. We are going to make them pay their fair share. We are going to fund healthcare, education, infrastructure, everything we need by finally getting billionaires to contribute. The crowd cheers. The opponents scream socialism, and then nothing happens. Or worse, something does happen, and it fails spectacularly. So here's the question nobody wants to answer honestly. Why can we not just tax the rich? They have more money than they could spend in 10 lifetimes. The math seems simple. Take some of their wealth, redistribute it, solve our problems. But if it were that simple, someone would have done it by now. Every country would have done it. Yet the places that tried it the hardest are the same places that quietly abandoned the idea. This is not about whether rich people deserve their money. This is not about fairness or morality or what kind of society we want to live in. This is about the cold, hard reality of what actually happens when governments try to extract more money from the wealthy. And spoiler alert, it almost never goes according to plan. Let me tell you about France in 2012. François Hollande became president on a platform of making the rich pay. He proposed a 75% tax on anyone earning over 1 million euros per year. The left celebrated. Finally, a leader with the courage to stand up to the wealthy elite. This was going to fund social programs, reduce inequality, and show the world that you could build a just society by simply taking more from those who have the most. 2 years later, the policy was dead. Not because of some corporate conspiracy or political coup. It died because it did not work. The tax raised about 160 million euros total. Sounds like a lot until you realize France needed billions to fund the programs they promised. Meanwhile, high earners left the country. Actors, athletes, business owners, they all moved to Belgium, Switzerland, the UK, anywhere with lower taxes. The tax did not soak the rich. It made them leave. And when they left, France did not just lose the 75% tax revenue. They lost all the other taxes those people were paying too. This is not just a French problem. This is the problem with taxing the rich anywhere. Money is mobile. Rich people are mobile. And when you make it expensive to be rich in your country, rich people stop being in your country. Before we go further, if you are tired of hearing simple solutions to complex problems and want to understand how money really moves in this world, hit that subscribe button right now. This is Disciplined Ego, and we are building a community that refuses to accept political talking points as economic reality. We dig into the uncomfortable truths that both sides do not want you to know. So subscribe, because we are just getting started. Now let us talk about why the math does not work the way politicians pretend it does. When someone proposes taxing the rich, they use what economists call static scoring. They assume everything stays the same except the tax rate. If there are 100 billionaires with $10 billion each, and you tax them at 10%, you get $10 billion. Simple multiplication. The problem is the people are not static. They react. They adapt. They hire accountants and lawyers who are much smarter than the people who wrote the tax code. When Reagan cut the top marginal tax rate from 70% to 28% in the 1980s, critics said it would destroy government revenue. The rich would pay less, so the government would collect less. But the opposite happened. Tax revenue from the top 1% actually increased. Not because rich people suddenly became more generous, but because at 70%, it was worth spending enormous amounts of money to avoid taxes. At 28%, it was easier to just pay them. The same pattern repeats everywhere. When tax rates are extremely high, people do not pay them. They find loopholes, they move income offshore, they delay selling assets, they restructure their businesses. They do anything except write a bigger check to the government. But when rates are reasonable, compliance goes up because avoidance is not worth the effort. This creates what economists call the Laffer Curve. It is a simple concept that politicians hate because it ruins their talking points. If you tax people at 0%, you collect $0. If you tax people at 100%, you also collect $0 because nobody will work if you take everything they earn. Somewhere between 0 and 100 is a sweet spot where you maximize revenue. And here is the uncomfortable truth. Most developed countries are already pretty close to that sweet spot. Raising taxes further does not bring in more money. It brings in less. Maryland learned this the hard way. In 2008, they raised taxes on millionaires, expecting to collect $106 million. Instead, the number of millionaire tax returns dropped by a third. The state actually collected less money than before the tax increase. Where did those millionaires go? Mostly to Virginia and other nearby states with lower taxes. They did not stop being millionaires. They just stopped being Maryland millionaires. California and New York are watching this happen in real time right now. Wealthy people and businesses are leaving for Florida and Texas at record rates. In 2022 alone, California lost $24 billion in income to outmigration. That is not $24 billion in taxes. That is $24 billion in total income that used to be taxed in California and now gets taxed somewhere else. The state did not just lose the high tax revenue. They lost all the revenue. And here is what makes this even more complicated. When rich people leave, they do not leave alone. They take their businesses, their employees, and their economic activity with them. A billionaire moving from New York to Florida is not just one person changing addresses. It is a headquarters relocating. It is high-paying jobs disappearing. It is suppliers and contractors losing clients. The economic damage is far greater than just the lost tax revenue from that one individual. But even if we could somehow trap rich people in high-tax states, even if we built a wall around California and forced everyone to stay, the math still would not work. Let us do some uncomfortable arithmetic. If you confiscated, not taxed, but completely seized, every single dollar of wealth from every billionaire in America, you would get about $5 trillion. That sounds like a lot until you realize the federal government spends over $6 trillion per year. You could fund the government for about 10 months. Then what? The billionaires are broke. Their companies are destroyed, millions of jobs are gone, and you still need to fund the government for the next decade. This is why slogans like "tax the rich" sound great, but fall apart under scrutiny. There are not enough rich people to pay for everything politicians promise. You could tax them at 100%, and it would not be enough. The real money is in the middle class, because that is where most of the people are. But politicians cannot say that because tax the middle class is not a winning campaign slogan. Even the programs politicians promise to fund with wealth taxes do not add up. Medicare for all is estimated to cost around $3 trillion per year. Elizabeth Warren's wealth tax, the most aggressive proposal from a serious politician, would raise maybe $275 billion per year. That is less than 10% of what the program costs. Where does the other 90% come from? Nobody wants to answer that question honestly. And then there is the enforcement problem. Wealth taxes sound simple. Count up everything someone owns and charge them a percentage. But how do you value a private company? How do you value art? How do you value intellectual property or future earnings potential? Jeff Bezos is worth $185 billion on paper because he owns Amazon stock. But if he tried to sell all that stock tomorrow, the price would crash and he would get far less. So what is his actual wealth? Whatever number you pick is basically a guess. Europe tried wealth taxes. Most countries abandoned them because they cost more to enforce than they raised in revenue. You need armies of assessors to value assets. You need enforcement mechanisms to catch cheaters. You need courts to handle disputes. And even after all that, the wealthy find ways around it. They move assets overseas. They put money in trusts. They invest in things that are hard to value. The administrative nightmare is not worth the modest revenue. But let us say we solve all these problems. Let us say we find a way to tax the rich that they cannot avoid, and that raises real money. We still have not addressed the fundamental question: what happens to that money? The assumption is that government will spend it wisely on programs that benefit everyone. But is that assumption valid? Because government spending is not free money. It is not magic. It is taking resources from one part of the economy and moving them somewhere else. And there is no guarantee the new place is better than the old place. When you tax a billionaire, you are not just taking cash sitting in a vault. You are taking money that was invested in businesses, stocks, real estate, and other productive assets. That money was doing something. It was funding companies, creating jobs, driving innovation. When you move it to government programs, you are betting that government can allocate those resources more efficiently than the market. Sometimes that is true. Often it is not. Government is really good at some things and really bad at others. Pretending it is universally better at deploying capital than private actors is just not supported by evidence. There is also the issue of what economists call deadweight loss. When you tax something, you get less of it. Tax cigarettes and people smoke less. Tax carbon and companies emit less. Tax wealth creation and you get less wealth creation. Every dollar raised in taxes does not just transfer money from rich to poor. It also changes behavior in ways that shrink the overall economy. The question is not just whether the government spends the money well. It is whether the government spending makes up for the economic activity that never happens because of the tax. Rich people do not just hoard money like dragons sitting on piles of gold. They invest it. They start companies. They fund research. They take risks on ideas that might fail. When Jeff Bezos was worth $1 million, he used that money to turn Amazon from a bookstore into the everything store. When Elon Musk made money from PayPal, he invested it in Tesla and SpaceX, two companies that were considered insane gambles at the time. If you had taxed away 90% of their wealth before they made those investments, we would not have Amazon or electric cars or private space travel. We would have more government programs. Maybe those programs would have been great, but maybe they would not have created as much value as Amazon and Tesla did. This is not an argument against all taxation. We need taxes. We need government. We need roads and schools and a legal system. The question is about trade-offs. What are we giving up when we take more from the wealthy? And are we getting something better in return? Because the promise that we can just take their money and everything will be fine is a fantasy. It ignores how wealth creation actually works. Here is the thing that makes this whole debate so frustrating. Both sides are lying to you. The left lies when they say we can fund everything by taxing the rich. The math does not work. The rich will leave. The economy will shrink. The revenue will not materialize. But the right lies too when they say we cannot raise taxes at all. We absolutely can. There is room to increase rates modestly without causing economic collapse. The question is how much and on whom. The real debate should be about trade-offs. If we raise taxes on the wealthy, we will get some more revenue, but we will also get some capital flight and some reduction in economic growth. Is that trade-off worth it for the programs we want to fund? That is a legitimate question with no easy answer. But instead of having that conversation, we get slogans. Tax the rich, trickle-down economics, class warfare, socialism. None of these slogans help anyone understand the actual issue. And maybe that is the point. Maybe politicians do not want you to understand. Because if you understood, you would realize they are promising things they cannot deliver. You would realize that funding a generous welfare state requires taxing everyone, not just the rich. You would realize that Europe's social programs are funded by high taxes on the middle class, not just on billionaires. You would realize that there is no free lunch. Every choice has a cost. So why can we not tax the rich? Because they are mobile and money is mobile and the global economy is competitive. Because the math does not add up no matter how much you want it to. Because wealth creation is fragile and easy to destroy and hard to replace. Because government is not magic and does not automatically spend money better than the market does. Because every tax has consequences beyond just raising revenue. None of this means we should not try to make the system fairer. None of this means rich people are perfect or that inequality is not a problem. But it does mean we need to be honest about what is actually possible. We need to stop pretending there are simple solutions to complex problems. We need to stop believing politicians who promise they can fund everything by making someone else pay. Because that someone else is not going to sit there and take it. They are going to leave. And when they do, we all lose. Thanks for sticking with us through this complicated topic. If you found this valuable, make sure you check out the next video that is about to pop up on your screen. We are going even deeper into how wealth and power really work in this economy. This is Money Trap Channel, and we will see you in the next one.